QuickBooks Pro Plus Desktop 2022 OneNote presentation, void check, and prior period adjustment. Let's get into it with Intuit's QuickBooks Pro Plus Desktop 2022. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side, Topic Introduction tab, down in the 1280 Void Check and Make Adjustment tab. Also note, when using OneNote, take a look at the Immersive Reader tool, Topic Introductions. They're also in the text area, same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Also realize that the name and number for the topic introductions will be the same as a presentation, because the topic introductions designed to give an introduction to the topic, provide screenshots and links when applicable, and give some accounting background that can supplement the information we'll be going over within QuickBooks in the presentations. Closing the icon on the left-hand side, we're looking at the process of the void check process, and there's a couple different things we want to consider when voiding the check. One is just the process of voiding. We want to think about the audit trail and why that might be important. And if we're avoiding something in a prior period, we want to think about what the impact will be there. And that could be a more general topic just with prior period adjustments in general. If you're working for the presentations and you don't have QuickBooks open and would like to follow along simply with the screenshots, you could use these screenshots to do so. We're looking at the vendor section, looking at the check form, which is outside the vendor section on the home page, but in essence is typically used in order to pay off a vendor. It can basically be thought of as a vendor type of transaction for the most part in that way. Scrolling down, we've got the balance sheet and the profit and loss report. Note that we're thinking about the checking account here, in essence the checking account going down when we write a check, and we want to think about the other side for the purposes of this check to be some type of expense account, such as a utilities expense type of account, because that will have an impact on net income. And if there's an impact on net income, then we have to think about, well, what will happen if I void the check? If I void the check in the same period, it's not going to be a big problem, because then I haven't closed out the period yet, so it'll basically reverse, in essence, what happened on the checking account, increase in the checking account, and the other side will basically go the other way, credit, or in essence decrease the utilities expense, netting out the check that we had written before. However, if we're looking at something that's a prior period check that we're voiding in the current period, when I void it, it will void it as of the date the check was written, and this net income will have already closed out and rolled into the equity section. That's when you run into problems, not only with voided checks, but with any kind of thing you're looking at making a change to the prior period, the voided checks being the most common kind of transaction of that nature. So in that case, we got to be more careful if we're doing something that's in a prior period and voiding the check. So then we've got the information with the check here. So we put in a check that we could then void. We made it a very large dollar amount. This is on this is on the check register at this point, putting this directly into the check register with the $100,000 check, and then we're looking to void that check. Note that the current period that we're looking at in QuickBooks is 2023. This check is in the system as of 2022. Now you could right click on that check and go down to void down below. You could also delete the check, which could have a similar impact. You could say, hey, look, if the check's no good, why don't I just delete it? That would be the easy thing to do. The reason you don't typically want to do that is because you don't have an audit trail. If you do that, you'd like to say, hey, here's the check. It didn't clear. I wrote it, I mailed it, or I thought it was something I needed to do, and now I'm going to adjust it at a later point. It will also be something that shows up in the bank reconciliations, and you'd like to be able to note that you avoided it at a later point in time. So you typically want to void the check, which will in essence do the same kind of journal entry as deleting it, but give you that audit trail, that being the idea. But if it's in the prior year and you void the check, basically deleting it, that's when you have the more complex issue. So if I was to void this particular check, then QuickBooks would give me this error. It's basically saying to maintain the accuracy of your financial reports and balance the accounts affected by the check, QuickBooks can create a journal entry in the earlier period and a reversing journal entry in the current period. Would you like to do this? If we say yes, QuickBooks will try to handle the fact that we have this prior period type of adjustment. If you say yes to that, then when you void it, it voids out the check as of the prior year, in this case 2022, it at zero now, but it also provides us that nice audit trail telling us this is a voided check, the check's still there, but has been zeroed out. QuickBooks then puts a journal entry type transaction in essence putting the check back on the books, reversing the voiding process that we just did before. And you might say, well, why would we do that? And the reason is because there's going to be an impact on income, and that'll mess up the equity section because the expense account rolled out into the retained earnings. So we don't want to change the income statement from the prior year because we already reported the prior year. So we need to have the audit trail as well as then do the adjustment, the reversing entry, actually in journal entry format in the current period. So here's what the journal entry looks like. It's a decrease to the checking account, like what the original check would have done. And then the other side going to the test account, which would be like the expense type of account. And then we have another journal entry that it made, and you'll note this one was made as of the current day that we voided it in the current period, 2023 in this case, putting the credit back on the books, just simply reversing this journal entry. And now we got the checking account going up and then the test account going down, which would be this expense account. That double kind of transaction is what allows us to basically deal with the prior period transaction. We'll take a look at that with journal entries and hopefully make that a little bit more transparent because it is a confusing concept. So then when you do the bank reconciliation, you'll note that we have these three transactions that are going to be impacted here that are going to have to be checked off in order to basically void the check. These two have to be basically netted out in order to void the check. And when you do the bank reconciliation, it will all automatically mark those off. So let's now think about this in terms of a journal entry. We're saying, okay, this is, let's say we have an original check that went on the books here, and then we wanted to void it. Now, if it was in the same period, let's think about it being in the same period just from journal entry standpoints and how that might work. Let's say the check was for something that was a miscellaneous type of expense. So we wrote a check, decrease in the checking account, which would be credit to the checking account, debiting the miscellaneous expense. If we posted that to the trial balance, this is the beginning trial balance on the left-hand side, transactions in the blue, ending trial balance on the right. What would happen to our accounts? The checking account for a debit balance account would go down because we wrote a check, decreasing it by $1,000 to the $99,000. The other side would be the miscellaneous expense, an income statement account, expense account, was at $600. We increased the expense by $1,000 to $1,600. The impact on the net income, which is sales minus the expenses. This is income, not a loss. The brackets actually mean credit in this case, not a loss. 24,710 went down because we wrote the check and had this expense go up to 23,710. So then if we looked at the general ledger for this transaction, we had the 100,000 checking account. This would be the detailed transaction detail report on the financial statements you could think about similar to. Minus or credit the 1,000 down to the 99. That matches what's on the trial balance. The 600 then went up with the debit to the 1,600 in our general ledger. So then if we were to void the check, so now we're going to go in and void it, the process of, in essence, voiding the check. But let's say we're doing it in the same time period and we don't have to worry about that prior period transaction, then the transaction will simply be a reversal of that entry. So if we reverse the entry, it would look something like this. The checking account's going to go back up, and then the other side is going to go to the miscellaneous expenses, reversing the miscellaneous expense. And if that happened in the same period, then those two transactions that we entered would net out up in the checking account, reversing us back in essence to where we were. And we'd have down here the reversal to the miscellaneous expense, taking us in essence back to where we were. So we had the beginning balance. Then we had it go down for the checking account to the 99. Then we voided the check, increasing the checking account back up because it didn't actually go down by that 1,000 because we voided it back up to the 100,000. The expense account was at 600 and then it went up by 1,000 to 1,600. Then we decided that that check wasn't an actual check. We voided it. So it goes back down to the $600. Now this second account, as long as this happened in the same time period, not really a problem. We can void the check without anything special going on. It would look similar to us deleting the check, but by us having two journal entries, this journal entry and the one above, we have a bit of that audit trail in terms of journal entry formats. And that's the similar kind of process that you would have for an audit trail when you had the check that is still showing there but voided instead of the check being completely gone. That's what you want to have with the audit trail. There will be a problem, however, if this expense account had then closed out because it was in the prior year to the retained earnings or equity section in the closing process, and then we reversed it in the current time period then we reversed it in the prior time period, and then our equity balance will not match what we had reported on our financial statements. In other words, if we reported the equity balance on the balance sheet in the prior year, then we adjusted the amount on the expense account that rolls into the equity section, then our beginning equity balance would be off, wouldn't match what the ending equity was in the prior year. So that's kind of the issue with these prior period adjustments, voided checks being one of the most common formats. So now let's think about a situation that we're going to say, okay, what if this was the check account? We wrote a check that we now are determined should be voided, and we did so in the prior periods. That's what the PY is going to stand for here. It was on 120 in the prior year. The expense account was debited by the 2,000. Checking account was credited by 2,000. And this is not something I'm going to post to the trial balance because it happened last year. So I'm not going to post it this year. It was something we're imagining happened last year. That's why it's this orange color. That's the thing that we need to reverse in the current time period, which is what's represented by the beginning and ending balances down below. The problem is that this office supplies account is not represented on this trial balance because the office supplies down here represents the current period office supplies. The prior period office supplies are in the equity section up top. They're in this equity section. So if I was to say void this as of last year, if I was to kind of reverse this transaction as of the prior year, then it would reverse the supplies and it would actually basically go to the equity section in essence as of the current year. That's the problem. Now with journal entries, I could just simply reverse it as of the current year. I could say, okay, that's the prior year. I'm going to keep that on the books instead of me reversing it prior year and then putting it back on the books in the prior year, which is what QuickBooks is in essence doing up top. I could just say I'm going to reverse it in the current year. Now the problem with this is that if I looked it up in the prior year, it would still look good. It would still look like it's a good transaction. I wouldn't see the reversal till the current year. What I would like to be able to say is this prior transaction, I don't want to remove it, but I want to reverse it and indicate that it's no good while still not adjusting the financial statements. So we'll do that in our next transaction with journal entries. But just from a journal entry standpoint, what would I do? I could just reverse it as of the current year. So if the current date was 1/15 in the current year, then I'm going to increase the checking account by the 2,000, and I'm going to put a credit to the supplies, which looks funny in the current year, but it'll be fine. But because the other option is for us to basically fix or correct an error in the prior period. What we would like to do is leave the prior period alone and then correct for the error in the current period if it's not a material item, one that's going to be significant for decision making. So that will throw off the financials, in other words. So if we have the checking account, then the checking account's going to go back up for that check that was voided, that was written in the prior year from 100,000 up to the 102,000 in the current period. And then the expense account was at 490 in current period, and now it's going down by 1,000, which is weird. And now we're resulting in a negative expense account. That shouldn't normally happen. The only reason it is happening here is because we're correcting for a prior period adjustment. That 2,000 that was in there last year that was included in the office supplies rolled into the equity. We're not going to change it as of last year. We're going to reverse it in the current year because we don't want to do the prior period adjustment because we closed last year and we're moving forward from this time forward. That's why we result in this negative expense account, which is a little bit odd. And then you'll see what happens to the net income. The 24,710, which is income, not a loss, actually goes up by 2,000 to the 26,710, which shouldn't normally happen with an expense. But again, it's because we're reversing, in essence, the voiding of the check from the prior period. If you look at the checking account, now we've got the 1,000 for all the activity that happened that went down from the first journal entry by the 1,000 to the 99,000. Then it went back up by the 1,000 to the 100,000. And now we had the second voided check increasing by 2,000 to the 100 and 2,000, that matching what's on the trial balance up top. The office supplies was at the 490. It went down by the 2,000 to the 1,510. This would be similar to the transaction detail report. Okay, let's add one more thing that will look more close to what QuickBooks in essence did, which is writing the check, voiding the check in the same period, voiding the check and then doing a reversing entry and then voiding it in essence again in the current time period. Let's kind of simulate that with journal entries. So this time we're going to start off with a check that we're going to void, telephone expense. So that would be like a check we wrote for the telephone expense, increasing the expense, decreasing the checking account. We're going to say that happened in the prior year. Therefore, we're not going to record it in the current items this period because our trial balance represents the current period's activity. And then what we're going to say, what would we do then to simulate what QuickBooks would do? As of 2/25, this transaction would be a reversing transaction from the prior year. So that would be similar to us voiding it. So we're actually going to void it in the prior year with this second journal entry. I'm going to post it down here so you can see what it would look like, but just realize that we're imagining that this situation is something that we would do in the prior year. And I want to show you what the impact would be on, the current year's accounts. So this is something that we would reverse last year. What would it do to the current year accounts? It would increase the checking account. So the checking account would go up, and that's a balance sheet account, a permanent account. So that does what you would expect. That would be what you want. The other side, though, wouldn't be going to the telephone expense. If we're talking about the impact on the current time period, it would be going to equity. Equity would be impacted because we would have hit the telephone expense last year, and then it would have rolled into equity. So the impact on the current financial statement would be that our equity, the 9265, would have a credit of the 4,000, increasing it to 92,465. This is the problem that we're going to have, because what we want in the equities, in this equity section, in the owner's equity, nothing should be going to that account except possibly owner investments. So if something else is going there into that account, then what's going to happen is our ending balance for last year in equity is not going to match our beginning balance, and that's going to throw off our financial reporting going forward. Since we already finished last year and we don't want to go back and change last year's numbers because we already presented them, unless there's some kind of substantial error that we need to account for, then we want to cut that off, say we're not going to go back and make adjustments in the past. We're going to go here forward and reverse the adjustment here. So that means that if I make this reversal, then I'm going to make another transaction, and this is what QuickBooks does. So QuickBooks would have said this would be the original check. This is the transaction representing the original check. This is us reversing it, in essence, voiding the check, the transaction at the same date, giving us that nice audit trail. And then this one is the journal entry that QuickBooks would make then as of the same date, in essence, putting the information back on the books. And so they would then debit the telephone expense, matching the original transaction, which negates the whole voiding transaction. Why would we do that? Because we want to show the audit trail by having these two matched up and not change the prior year numbers, and then do the transaction in the current period so that we can have the numbers going from this period going forward. So in current year, what would this do to the current year? Well, these two 400s would net out in the equity section, and that's the point. So we just reversed it. We reversed the checking account, and now we've netted out the equity section so that, in essence, the change that we made to the income statements in the prior year isn't messing up our equity, and we have then this audit trail that's happening. Then, in the current period, then, now we can finally record the reversing entry in the current period, which is what QuickBooks does with its last journal entry as of the current period here. And then we just say the checking account's going to go up, and we're going to credit then the telephone expense at this point in time. So this accomplishes in journal entry format with regards to the journal entry the same thing as our second method, meaning why didn't I just skip these two transactions in the middle and just say I had this first transaction last year and then I'm just going to record this as of the current time period. You could do that from a journal entry standpoint, that would work, but when you're trying to create the audit trail, it doesn't give you that audit trail. So what QuickBooks wants to do is say, this is the check, I want to show it voided, which in essence is going to do this, but then I don't want to mess up the prior year, so I'm going to put it back on the books with a journal entry, and then I'm going to make the journal entry in the current year so that we don't mess up the prior year and we can still make the adjustment as of the current time period, and we have the audit trail. So now as of the current time period, this would be going to the checking account, increasing, included in the checking account here, and then finally we can actually hit the telephone expense in the current time period down here, the 2,700 going down by the 400 to the 2,300, the impact on net income to the current time period then being the 24,710, and then that is going to be included in this 2,400, which is actually increasing the income, which is weird for an expense, but that's because we're reversing the kind of voided check in the prior year to 27,110 in total. So the checking account went from 100,000, we decreased it by the 1,000 to the 99,000. We then increased it by the 1,000 back to the 1,000 for that first voided check. Then we had the 2,000, increase it for the second one to the 102,000, and then we had the 400 for that last one, bringing it to the 102,400. Then in the telephone, and notice that you might be saying, well, what about these green items here and that yellow items? That's all prior year activity, and that basically is included in the beginning balance up top. The telephone was at the 2,700, went down by the 4,000 to the 2,300. And again, you might be saying, well, what about these two that hit the telephone expense? They hit it in the prior year, and therefore they hit equity, in essence, in the current year. That's what we're trying to show by them being green in that instance, showing some prior year activity, which I know that's kind of confusing. These prior year adjustments can be kind of confusing. So if you saw this in terms of recording the transactions from a journal entry standpoint, you would record the journal entries here. Then typically you would have those journal entries then be posted to the general ledger. The general ledger then would be used to create the trial balance, which we broke out between beginning and ending, so you could see some of the journal entries we're focusing in on and the direct impact from the beginning to ending balances. Then if any accounts were impacted that also needed a subledger, like the accounts receivable, accounts payable, and the inventory, then we would be selecting those items as we enter that information. We'd use the trial balance finally to create the financial statements, balance sheet, income statement, and statement of equity. And from a QuickBooks standpoint, once you enter the transactions or void the check, for example, you might then just go right into the checking account and double check that the check is doing what you would expect, taking you into, in essence, a general ledger account to see the detail in the general ledger account like this. And that would be the general kind of difference between creating the financial statements from scratch with journal entries to doing it in QuickBooks, where you enter it with a form, then go to the end result, which QuickBooks has created using this process, and then drill back down to the source documents, drilling down from the balance sheet to, say, the transaction detail, which is in essence is a general ledger account, then drilling back down to the source document, which is in essence the thing that creates the journal entry.